Hello, everyone. I'm Magdalene here from Itus Capital, and I'm delighted to welcome you all to our first quarter investor call 2021. Thank you all for taking the time to be a part of the call. At this time, all the participants will be in listen-only mode, and after a presentation, we will have the Q&A session. So today, our focus will be on the recent performance of the portfolio and an update in the market. Naveen Chandramohan, our CEO and Principal of Itus Capital, will walk us through it. Over to Naveen.
Thank you, Magdalene, for the kind introduction. And good morning, everyone. I sincerely appreciate you taking time on a Saturday morning to attend our quarterly call. The markets are in a very interesting and healthy space at the moment. The risk of a second lockdown and the COVID cases increasing is a real one. However, I do believe that as a country as well as globally, we are better equipped to face this both domestically as well as internationally. There could be certain amount of volatility that we expect that can continue over the next few months. However, I do believe that both companies as well as industries are in a much better position, and so are markets as things progress from here. We start our call on a quarterly basis, recapping where we left off in the previous quarter. If you remember, for those who attended our previous quarterly call, this is how we summarized and ended our Deck 2020 investor call. We expected 2021 to be a good year for equity investors. However, we did warn that volatility was going to be for the par for the course. Predominantly, this was stemming from the fact that the environment of easy liquidity will mean that the discipline of every investor was going to be tested. We expected strong inflows into EM to increase going into 2021, and that automatically meant, as far as we were concerned, a better allocation into India as far as FIIs were positioned. From a fundamental perspective, our hypothesis was India was going to be primed to benefit from a low rate as well as a low interest rate environment as well as a low rate on oil prices. One aspect that we did say was we didn't feel that capex was going to come into the system aggressively yet. Most of the move in the capex, predominantly from cyclical as well as the core industrial segment, had come off in the last 9 to 12 months because of supply side distortions. Now, in any cyclical business, there are two sides to the coin. The supply side distortions obviously helped in terms of the price actually moving up for many of these segments. However, the demand side aggressively moving up, we still don't see the levers for that coming through aggressively. Coming back to our portfolio, in 2021, in the first 3 months, the fund was up 3.7% versus the benchmark at 5.1%. The negative performance, underperformance of the fund versus the index, being Nifty 50 in case here, was predominantly driven by the fact that a lot of cyclical stocks, which basically refers to core metals, energy, industrials, and capex heavy businesses, hugely outperformed in the quarter. There is a potential reason to believe that this outperformance could continue, which means that in the short term, growth-oriented companies may underperform. And like I have maintained in the last call, we are fine with that underperformance because it's important for us to stick to our core philosophy of investing. If you zoom out from a performance perspective of our fund, since inception, the fund has generated a cumulative return of 144.7% after fees to investors, in compared to Nifty, which is generated close to 80% over the same time. So the fund has outperformed over Nifty on a healthy 65% over the lifetime of the funds up to March 2021. If we were to look at the same thing in terms of every rupee of fund invested, investments into the fund, 1 rupee invested for an investor who's been with us since inception would see the NAV at close to 2.45 today, as against 1.79 on the Nifty. What that means on an IRR basis is a cumulative IRR of 23.5% for the investors as against 14.77% on the benchmark Nifty. We'll spend some time on the next few minutes talking about what we did in the quarter, why we took those decisions, and what impact it has on the portfolio. So I've always maintained that Itus is not a buy, hold, and forget investment vehicle. We do actively monitor the risk. And in line with that, in the last quarter, we completely sold out of our position in Axis Bank. And with the proceeds, we bought CAMS in the portfolio for the first time and also added exposure to our portfolio company called Galaxy Surfactants. So I want to spend some time talking about the rationale for the exit of Axis Bank. And I have always looked at banks as leveraged entities which require an active risk management philosophy and discipline from a shareholder perspective. Now, there are many ways to look at analyzing banks. There are price to book metrics. There are NIMs that are used, which is net interest margin, around which the leverage is actually operating. But one simplistic way that we would like to explain to our investors around how we evaluate banks is a metric called PPOP, which stands for pre-provisioning operating profit. So what this means is effectively uh, in a life cycle of a bank, there are something called NPAs, which stands for non-performing assets. And NPAs are pretty much dependent on the cycle in which a particular market is operating in. And against those NPAs, you have provisions that a bank normally takes. What these provisions are used for is effectively when a non-performing asset goes into an actual default, the bank uses these provisions, which act like reserves, to cushion against the fact of an actual default on a loan that the bank has given money against, right? So out here, while the short term, the NPA cycle is going to be volatile depending on the credit growth in the environment as well as the health of the economy. Over a 10-year cycle, the NPA cycle normalizes itself. What that means is you actually have periods of bull and bear markets over a 10-year period, and which is where I'm talking about a normalization in that cycle. So over the last 10 years, what we are looking at is the pre-provisioning operating profit growth of the three largest private sector lenders in our country. Here we're talking about HDFC Bank, ICICI, and Axis. So if you look at the top table, right, we're talking about on a year-on-year basis, how has the PPOP of these three private sector banks grown in the last 10 years, right? Ideally, just as a particular company, what we care for is free cash flow growth. And because it's this free cash flow growth that results in shareholder returns, similarly, for a leveraged entity, we are using a proxy called PPOP. So if this proxy is technically right, what you want is your PPOP growth matching or at least having a very close semblance to the reality of actual shareholder returns. So if you look at the table at the top, HDFC Bank holds this unique proposition of having a consistent year-on-year PPOP growth over the last 10 years. Whereas if you look at an ICICI and an Axis, the growth is a lot more cyclical. Why do I say that? Because you've had years of PPOP actually degrowing. Now, why is HDFC Bank is in such an enviable position is because not just in India, if you take global peers, right, from the likes of a JP Morgan or Bank of America in US, or let's say a Bank of China in China, you don't have a precedent set by a leveraged lending institution which has shown this level of consistency on a year-on-year basis, right? So if you look at what the PPOP growth on a cumulative basis over the last 10 years is, you're talking about HDFC Bank growing by 635% and ICICI and Axis growing almost half of that. Now, compare this table at the top to the table at the bottom, where you're talking about actual shareholder return. So if you look at the numbers right at the bottom, right at the end, the PPOP growth for the three banks kind of roughly matches with the shareholder returns, which is represented in the bottom table, which is what you would like to see. Now, one of the reasons why ICICI Bank and Axis Bank have compounded capital at a much lower rate than a HDFC Bank is because you don't find that consistency in PPOP growth. As a shareholder, what you want to see from a company is consistency in growth. And very rarely do you find that in lending institutions because of leverage being involved. So, if you remember back in March, April 2020, we actually increased our financial exposure. And many of them were actually asking us, why are we doing this? Because it was uncertain times. We were doing it because if you look at the dichotomy of what was happening within these institutions, you were talking about a shareholder return of anywhere between 20 to 45% on the negative because of the lockdown that not just India but globally we were faced with, versus a PPOP actual growth of anywhere between 12 to 30% depending on the bank that we were talking about. Now, come March 2021, there has been a lot of normalization between the shareholder returns as shown in the bottom table in the last 1 year versus the actual PPOP growth seen in 2021, which is where we felt it was rational and prudent for us to reduce this exposure in financials and redeploy the capital into better run companies where the cost of capital as well as the opportunity cost was a lot more significant. Do realize that we being a multi-cap focused fund means that we are always looking for the best avenue to deploy capital. We are not so concerned about having an X exposure in financials because the index has a Y exposure in financials. That's never been how our constraint for deploying capital has been. Now, I also wanted to take a step back to explain why operating cash flow or OCF or PPOP for the lending institutions matches historically with the actual returns that you see in any company. Out here, we've taken the Nifty as a benchmark and we're looking at on a year on year basis, the blue effectively shows the returns of the index every year, and the orange tab shows the OCF or the PPOP depending on which kind of a company that you are evaluating, the growth rate over the same period. So as you can see, the beauty of the equity markets is while in the short term, you don't expect the two to react in tandem, in the medium to long term, over a 5, 7, 10-year cycle, both of this should normalize. And the places where you have a maximum deviation are the places where, as an investor, it's good, or rather, an investor can be slightly more aggressive in deploying money into equities. Where did that happen? It happened three spaces in the last 10 years in India. One was in FY12, another was in FY16, and third was in FY20. And if you look at it, generally the 3 years subsequent to this has been fairly strong in terms of equity returns from just purely an index perspective. Here, what we are saying is you don't have the ability to stock pick. All you have to do is to invest in the benchmark Nifty companies when this deviation actually happens. Now, how is actual Nifty done in the subcomponent of the names that actually belong to the Nifty index? So, this table talks about the growth of Nifty over the last 10 years, and the subsequent column talks about the growth of the OCF of the PPOP for the constituents of Nifty over the same period. So, as you would expect, the growth Nifty has grown from 100 rupees and in Nifty has grown to around 252 at the end of March 2021, and it's kind of matching with the same 100 growing to 278 from a OCF or PPOP perspective, which is what you want from a long term perspective. However, once you study the breakdown of each of the components, what's interesting is more than 60% of the companies in Nifty have not shown free cash flow growth over the last 10 years, which basically means only 4 out of 10 companies have actually shown free cash flow growth. The remaining are more of long term value destroying. And 15% of the companies have only shown 12% growth structurally. So it's only 8 out of 50 companies that have even shown a 12% growth on a structural basis in the last 10 years. So effectively, what this goes to show is, if as a fund manager or an investor, you have the ability to basically just select those companies which have a structural free cash flow growth, you have a very good chance of outperforming the index that you are benchmarking yourself against. So, with that as the context, I want to delve deeper into our portfolio holdings and how the actual growth rate and the numbers are turning out to be, both from a top line and a bottom line perspective. Out here, since we are still talking about being in the first week of April, the numbers that we are looking at is still as of DEC 20 earnings. In the next quarter, we will evaluate the same on a March earnings numbers. So the first segment from a financials perspective, currently we own only HDFC Bank and ICICI Bank, both of which have recorded fairly healthy growth, both from a top line as well as a bottom line perspective. So the interesting thing about both the holdings is they continue to gain market share as well as grow at a healthy mid to high teens from a net interest margin perspective. So the reason both of them continue to be a significant portion of our financial exposure is predominantly of this aspect of market share growth that we are looking for. Now, in the same financials bucket, we also own an asset management company called HDFC AMC. So this has been not so beneficiary of the AUM growth that's happened within the mutual fund space. The overall AUM growth in the mutual fund space has been tepid in the last 2 years, and HDFC AMC has been a significant laggard within that. So the equity AUM for the company has underperformed versus the industry, predominantly because of tepid performance over the last 3 years. What's interesting to note is, even though you've had a significant drag from a top line perspective because of the AUM degrowth, the bottom line continues to expand. And that's one of the primary reasons HDFC AMC continues to be a part of our portfolio. You have an institution which has underperformed the rest of the industry, has slightly lost market share against the rest of the industry, while it has managed to keep a good handle on the costs and margins and ensured its bottom line is still growing. We continue to believe that in an environment like this, HDFC AMC will be one of the beneficiaries of equity AUM growth, and we should see a better recovery in the top line over the next few quarters. Now, coming to pharma, our exposure is across three companies: Syngene, Alembic Pharma, and Alchem Labs. So, two of them recorded healthy growth both on a top line as well as bottom line perspective. The drag on our portfolio came from Alembic Pharma. So, I just wanted to spend a couple of minutes on this. The Alembic Pharma has both an India component of its business as well as the US component of its business. The India component saw a strong growth of close to 14%, whereas the US component saw a fall off in growth predominantly from increased competition due to sartans, which is one of the drugs that they manufacture. The second headwind came from the fact that US FDA, there was a delay in the licenses, which effectively meant a put off of the production cycle that Alembic Pharma had planned due to capex. So the expectation based on how we look at management commentary is the ramp up of the API production could take slightly longer than expected, and the US business could come into additional pressure over the next few quarters. However, you're talking about a fairly strong balance sheet. You're talking about a company that's grown its free cash flow by almost 90% in the last 3 years. So inherently, while the near-term headwinds do exist and are real, we still believe that the company is structural in nature and should benefit over the next few quarters in terms of a long-term perspective. The third component of our bucket is what we call monopolistic financial services. These are companies which have a lion's share of the market in the space that they operate, or pretty much are the only player in the space that they operate. So we own two companies, CAMS, which I told you was a recent addition in our portfolio, and Indian Energy Exchange, which is an exchange where both short-term, predominantly short-term power contracts are traded. Both of these companies had very strong quarters, and the thesis behind both for CAMS is pretty much the thesis of the growth of CAMS is tied very closely with the growth of the mutual fund industry. And for Indian Energy Exchange, you're still talking about a business where only 5% of the total contracts are traded on the exchange. The marginal operating leverage from an exchange perspective accretes directly into the bottom line. So while the company has still done well over the last 1.5 years, we do believe that from a shareholder perspective, the growth story of IEX is only getting started. The fourth is what we call tech or platforms. Here we have exposure across three companies: Infosys, L&T Technology Services, and Route Mobile. Infosys recorded a fairly robust quarter. In fact, you saw that across all tier one tech vendors in India. For Infosys specifically, it was the largest ever contract win from a size perspective in a quarter, where they won a contract worth USD 7.1 billion. And the last 2 years, the amount of focus and spend on training, predominantly for the employees, is paying dividends today in terms of the kind of contracts that they are winning. And if you look at it from a balance sheet perspective, you're seeing ROCE also improve along with the top line expanding, which is a very good sign for a company like Infosys to be growing at this scale. For L&T Technology Services, the play is slightly different. You're coming off a IT tech company in a space which has seen significant amount of degrowth. However, there are quite a few tailwinds that are assisting the company today. You're seeing that in terms of the largest ever contract win for L&T Technology Services since inception. That happened the previous quarter. Now, considering that a lot of industrial products and plant and engineering companies are seeing a recovery, the natural beneficiary of that in terms of IT spend is coming to a company like L&T Technology Services. And also considering that oil and gas is another sector that they have a fairly heavy exposure in, the recovery in this space is potentially likely to see better in terms of higher margin products coming to them. And third is a smaller company called Route Mobile, which recently came out with an IPO back in November 2020. This is a CPaaS player based out of India, and the tailwinds and tailwinds that COVID has provided in the last 1 year has benefited the company quite a lot. Today, the concept of communication as a service has become an imperative focus for most companies, be it small or large, and a lot of that spend is going to companies like Route Mobile, which have established relationships with both telecom and infrastructure vendors. The next space is a space combining both chemicals and manufacturing under one. Here we have exposures across Balkrishna Industries in auto inks and Galaxy Surfactants and Sumitomo in specialty chemicals. This space again saw a fairly robust growth across both top line and bottom line perspective. From a Balakrishna Industries perspective, the earnings, while they were extremely robust, the market didn't take the new capex of around 2,000 crores that the company announced for its downstream integration of carbon black very well. And that's expected, because when a company is looking to expand its supply chain into a commoditized space, you're not very sure whether that is an efficient use of capital. From our perspective, the way we see it is not looking at forecasting this and calling it good or bad, but the fact that a lot of this capex, more than 85% of this capex, is funded from internal accruals. So the health of the balance sheet does not get affected. The demand for the tires has been fairly robust. They are operating at a very healthy capacity utilization. So they are basically downstreaming and integrating the carbon black production into their capacity, which should improve the margins over the next 2 to 4 year cycle. In terms of galaxy surfactants, the thesis is on specialty chemicals, predominantly them having close to a proxy monopoly in India. The rest of the world, the export market is close to 40%, whereas the domestic market is close to 60%. And the company has been expanding its capex. And over the next 2 years, along with the raw material increase, that could dent the margins over the short term, predominantly because one of their raw materials, which is basically coming from palm oil, the price has been increasing. And while if you look at past cycles, this tends to normalize itself. If you look at it on quarter earnings perspective, this could have near term impact over the next few quarters. Sumitomo Chemicals, the business is mostly around specialty chemicals in the agri space. You have had, because of the Excel crop acquisition, the ROCE is actually improved significantly, and we expect that to continue over the next few quarters. So, if you look at our portfolio and the holdings, they predominantly come from six core themes: private sector banks, non lending financials, both AMCs and insurance, exchanges, which are what we call monopolistic financial platforms, pharma, IT bar tech, and the last one is consumer focused, both consumer facing and B2B. Now, Itus has always been a multi-cap focused fund, and our exposures have predominantly varied between large, mid, and small. We've not had a bias saying that we will invest only in large or only in small. For us, it's about understanding the business and looking at it from a free cash flow perspective to see where there is growth and why it should fit our core portfolio. So if you look at what the weighted average ROC of the portfolio is, that's been at a rough, healthy 28%. And if you look at how our earnings growth from a bottom line perspective at the portfolio level has been, it's grown at around 22%. And the most important metric that we track is from a free cash flow perspective, the portfolio is growing at a 14.5% at an aggregate level. What that means is at a base case normalized world, you would expect this portfolio to generate a 14.5% IRR over an annualized basis. So, having spent a decent amount of time on our portfolio, our positioning, as well as what we did in the previous quarter, I want to spend the next part of the presentation on the common questions that we've been getting asked, both from our investors and partners over the last few months in our interactions with them. Most of them are around risks, because markets being at an all-time high means investors have this at the back of their mind saying, what can go wrong, right? So first risk is around the yields going up. As you're aware, interest rates going up, the hypothesis laid out in the market is it's not a good environment for equities because the discounting factor has changed, as a result of which equities should correct. And what has happened in the last few months is the 10-year US yields have gone up by more than 1%. And considering that the base was 1.5% only before this move, that's a significant increase. So that is a top of the mind recall question as far as most investors are concerned. So while the thesis and the broad statement of interest rates going up fairly quickly, not being good for equities is a fairly abused one, it's important to take a slightly more disassociated stance to this and look at what actually happens in, or what has happened in the past, and does that mean probabilistically what kind of an environment we could foresee over the next few quarters or years. So if you look at so this chart basically talks about what your short-term interest rate in the US is in the past over the last 20 years, and how has Fed hiked or reduced the interest rates in the past. So the last time you saw a significant move up in interest rates was between 04 and 08 and 16 and 20. And while in 16 we were at a very very similar base before this move up in interest rates happened over the last 4 years. It's important to realize both of these two periods coincided with one of the strongest bull markets in the US. 2004 to 2008 saw a pretty significant expansion of the core US economy, both from a jobs perspective, from an inflation perspective, as well as from an equity markets perspective. And the same thing happened between 16 and 20. If you remember, last 10 years have been the biggest bull market for the US in a decade, right? The S&P has analyzed close to 14.1% over the last 11 years, which coincides with the biggest, longest running bull market so far that we are sitting in. So it's while it's easy to say that interest rate increase is a cause for panic, what's also important to understand is just because interest rates are increased over subsequent quarters, because we have seen that over a 4 year cycle in the past, it doesn't mean equities as a standalone will underperform. So the same thing has been represented in the form of 10-year interest rates. So the chart above talks about the monthly movement in S&P prices over the last 20 years. And the same thing has been juxtaposed upon the 10-year interest rate movement. So out here, it's the 10-year T-note that we are talking about in terms of how the interest rates have moved in this space over the same period. The points that are marked in circles are what we call inflection points, where there are significant move up or down in either equities in the top or interest rates at the bottom. And both of this where they coincide. So for example, here you're talking about a move down in interest rates coinciding with a move up in equities. Whereas in this period, you're again talking about a move down in interest rates. This is again not short term, this is more so 10-year, the long end of the curve, which effectively talks about how your long term interest rates are going to move versus the move down in equities over the same period. What you're basically highlighting out here is the correlation between interest rates and equities is not 1:1 from an inverse perspective. What that means is just because interest rates go up doesn't mean equities are going down, because that's not what is substantiated in history. The second thing that I wanted to highlight is the often talked about commodity pricing and the fact that today, as an economy, both in India and globally, we are in a super bull cycle as far as commodities are concerned. So, the often asked question that we receive at Itus is how come we don't have any exposure in commodities to play this theme? Right? So, before we go into numbers and how the cycles in terms of business indicators have moved in the past, one thing that I wanted to explain in further detail is our core philosophy around any investment that we make is we want to be seeing growth from a free cash flow perspective. Unless and until we see that growth, we are not looking at that company as a structural holding in our portfolio. Today, most of the commodity price increase that we have seen has come from the supply side distortion. What we would actually be more comfortable to see is the demand side equation pick up. So, as you can see out here, uh, we have come up with a proprietary model to indicate the health or the business cycle of an economy through a combination of jobs, unemployment, inflation, PMI, which is basically manufacturing and services, and juxtapose the same with copper prices during the last 10 years. So, any time that the business cycle is contracting, right, the number is falling, you see the copper prices actually having a downward trend as well. And this has happened in the past over multiple years in the last 10 years. So, effectively, the health of the economy is directly correlated in the old school world of functioning with the commodity prices. And out here, we're using copper as a proxy. So, if you were to take a much more longer stance around how commodity prices have moved, you look at the previous bull cycle that happened between 2002 and 2008, right? It was a one-way stream, a 6-year bull cycle, and as against that, one could say that we are only getting started if one buys into this thesis, right? What's important to understand is the 2002 to 2008 cycle started off in 2002 with a supply contraction story, but over the next 5 years was predominantly funded in the demand cycle by China. It was Chinese capex that effectively funded the bull market in the super bull cycle, as we call it, in the commodity space. Today, that demand cycle has not yet started. We don't see that in the US, neither are we seeing that in China. Now, technically, can we see that in India, and India being the next story for funding it? It's a story. We're not seeing that yet in terms of numbers. There is very little merit for us to buy into a story yet, and hence we would like to believe that this is more of a cyclical story, and we would like to stay out of this as we speak, having consciously said that as long as the numbers comes out, we would be happy to change our stance. Final thoughts as we end our presentation today. We do see growth coming back across the board. In many cases, it's because of the supply side of the equation getting shut down. There are multiple early signs to believe that the demand is picking up in many sectors and businesses. From our philosophy perspective, we continue to stick to companies which show a free cash flow growth in our portfolio. From a broad thesis and a macro perspective, we do look at interest rates continuing to remain low and do not see this environment changing. One sobering thought that I would like to leave everyone on this call with, right? So, which I picked up recently from an exchange filing. Currently in India, so you've had 50 years of technically mutual funds being promoted in India by MFDs, advisors, investors, etc. And if you talk about the actual private sector getting into the space, maybe you can talk about roughly around 28 years of mutual fund industry growth. You have currently 2.2 crore of investors with MF portfolios as against 1 crore of investors who are currently invested in Bitcoin, albeit at a much smaller ticket size, but still. I think basically goes to show you. And with the fact that Bitcoin, the entire investments have been with completely only a pull factor. There's not been any push into investing in Bitcoin. Just goes to show you the kind of environment and the liquidity cycle that we in both globally and in India are in today. Maggie, as we end this presentation here, we can now open the floor to questions. Anyone can basically use the Q&A section and ask your questions. The questions will be visible only to the panelists and the organizer, and we'll be able to answer all as many questions over this particular time period. The first question is around, I'm just going to read it out aloud for the benefit of the others as well. Don't you think the time has come to see some of the PSBs, public sector banks, as their operating profit has been good, and even though they had issues of NPAs before? Like I said, while I covered the aspect of PPOP and our exit of Axis Bank, this is how we look at leveraged lending institutions. Now, if you look at public sector banks, optically, they are extremely cheap. There's absolutely no doubt about that. But then the question is, they've had much larger and impending NPA cycles to deal with. So there are two questions that you are dealing with when you're investing in a PSB. A, you are basically pricing in the fact that the NPA cycle is going to normalize, which is as a result of which your PPOP is going to significantly increase. And second, you're also believing in their ability to say this operating profits that they generate, they have the ability to reinvest. And the reinvestment for a lending institution like a PSB is to lend more, right? We don't derive comfort in either of this yet. And I don't see that changing because there has been a significant amount of misallocation of capital in the past. Gaining market share has not been what their focus is on. It's predominantly been on managing problems. We would like to stay away from this place and continue to invest in the pockets where we see growth and market share expansion. The next question is on Alembic Pharma. Alembic business in the US has seen a negative growth, whereas in India they're growing at 14%. What percentage of the Alembic's business comes from India? So I touched upon this briefly. Currently, only 40% of the business comes from India. A majority of the business still comes from the US. Though it is 40%, it's important to realize 3 years back it was close to 30 to 31%. So the India business has been expanding, has been on an upward trajectory, and it's a higher ROCE business. So, like I said on the call, there are additional headwinds that I continue to see on the US business. It might last longer than what we anticipate. However, we're looking at a business with a healthy balance sheet as well as a strong free cash flow, which is why we're continuing to hold on to it. What's your view on how the new surge in COVID cases may affect your portfolio valuation? Any learnings from the previous lockdown? So, the way I'd like to answer this question is anytime humans as a race are provided a first shock in their life, it is extremely jolting on us, right? So, for example, I don't know if any of uh, uh, not that I want someone to have this, but if you've experienced a close family member going through some kind of a cardiac surgery for the first time, it's very hard to handle, right? Because you don't know how to deal with things the first time. But the same thing the second time is a lot easier because you're slightly more better prepared for it. And I think currently what we are dealing with, while it is scary from a numbers perspective, while it is a lot more from a multiple perspective versus last year, I think as a nation, globally and in India, we are better equipped to handle this. So I don't see us going into a national wide lockdown yet. The cases may rise, it may happen, but I do think we are better equipped. In terms of learnings, I think there are quite a lot of learnings. We've stuck to our philosophy of investing in free cash flow businesses since inception of the fund. That was the core philosophy around how we started the fund. And I think that got revalidated during COVID, right? Many businesses were affected. Many businesses went from basically extremely healthy revenues to pretty much zero over certain weeks. But what actually helped many of these businesses to come out was the strength of their balance sheets, and that predominantly is coming from how well they manage their capital structure and how well they've actually managed to generate free cash flows in the past. So, sticking to your process, staying disciplined around it, and ensuring that you don't deviate depending on what is the flavor of the theme or flavor of the market has been our biggest learning from the COVID period last year. The next question is, when you invest, what is the time frame that you keep in mind? So technically, we are looking at an investment as a slightly longer term investment, which in our mind is roughly around 3 years, right? Having said that, we evaluate our thesis on a quarterly basis to ensure the three of our levers that we look at: the growth that we anticipate, the price at which any business is trading at any point of time, and the corporate governance of the business doesn't deviate from what our core hypothesis or thesis has been. So we have what we call a 3 year vision around what we anticipate for the business, but we monitor the risks dynamically. Doesn't mean that we have to exit the business in 3 years, right? Because over the next 3 years, businesses evolve, cash flows evolve, dynamics evolve, and we constantly reevaluate that. So, for example, HDFC Bank has been a core portfolio holding since the inception of the fund, which has been more than 4 years now. So, it continues to be there in the fund. We've not trimmed a single rupee in that exposure as of yet, right? So, we look at long term as 3 years and then dynamically evaluate the businesses as time goes by. How do you take your selling decisions? Again, it's been, I think this is a constantly evolving process as far as we are concerned. We've made multiple mistakes in the past, and I'm confident to say that as the fund grows, as the performance continues to stay consistent as we see it, we will make selling mistakes too, because there is no perfect selling decision. For us, our selling decision is governed by our GPCG framework. What that means is, for us, our comfortable investment holdings in the past has been anywhere between 17 to 22 investments in the portfolio, right? So what that means is, every decision that we take at any point of time is either selling a certain business in the portfolio and replacing it with a better quality, what we call a better cash generating machine or a higher ROCE business. So that's where the price at which a business is trading matters to us. Similarly, the growth that a business shows automatically gets translated into the return that we actually have from an opportunity perspective with that business being in our portfolio. The third aspect is the corporate governance, because businesses, end of the day, are run by humans. There are mistakes that we figure out over time from either a capital allocation perspective or a related party transaction perspective or the way accounting is done. If any of this happens, we will immediately exit the business, come what may. So these are the three driving factors that matter to us around our selling decision when we value any business in our portfolio. With already high penetration of two-wheeler per household, commodity price increasing, is stocks like Balkrishna a good strategy in your portfolio? Is it the right time for them to expand as per your statement? So I think it's going to be hard for as a fund manager to comment on what is the right time for them to expand. As a promoter, when you have good free cash flow in your business, you have three options. You have the option to pay out dividends, you have the option to acquire, or you have the option to expand. Right? Now, Balkrishna has chosen the third in terms of expansion. And the way they have done it is to downward integrate from a commodity price raw material perspective. Whether it is a smart decision or not, time will tell. Our role as fund managers or investors is to evaluate it and basically say, how has the capital allocation decisions been of this management in the past? Have they made flawed investment decisions? Have they been very reactive around going in terms of spending money at the wrong times? And if not, why are they doing it now? And if yes, what is the demand cycle like? The way we see things, we don't see anything untoward in their expansion strategy yet. We will look at this being margin accretive over the next 2 to 3 years. Over that, we will look at monitoring. Over this period, we will look at monitoring the demand cycle for the company and evaluating whether it was a smart decision or not. But like in life, you will always know in retrospect whether it was a smart decision or not. And like I said, as far as we are concerned, we are not married to any investment. For us, it's about a capital allocation exercise that we are undertaking. And today, as we see things, we still believe that there is a lot of value that we believe as minority shareholders, it adds value to this investment being in our portfolio. Maggie, I don't think there are any more questions. In this case, we should be good to close the call. Thanks.
Sure, Naveen. Thanks for the update. And thank you all once again for your patience on the call. The recording of this webinar will be sent out once it's made available. Have a nice day and stay safe.